welcome to this video on Business and Entrepreneurship Education Grade 9. Today we'll look at Unit 8, which is on spending, savings and borrowing. Lesson 1 is spending. Learning objectives. At the end of this unit, you should be able to define spending and identify the factors affecting spending. What is spending? People work so as to satisfy their needs and wants by buying goods and services. Needs are things that we must have in order to survive, whereas wants are things that we would like to have to simply enjoy. Money earned is known as income. When people work, they have to pay taxes from their income to the government. Income of individuals or households is used for spending as well as savings. What is disposable income? Disposable income is the amount of income available for spending after taxes are paid. Disposable income can be calculated as follows. Income minus tax is equal to disposable income. Spending refers to paying out money to buy goods or hire services. People with high income usually tend to spend more, and people with low income usually tend to spend less. People can spend their income in many ways, such as on basic needs, that is, food, water, shelter, clothing, to pay utility bills, such as mobile phone bills, water bills, electricity bills, and so on. For leisure, for their education, and for healthcare. Let us see an example of spending. Hello, my name is Sue. As it is the end of the month, here are the goods and services I spend money on. As you can see, Sue spent money on basic needs, to pay her utility bills, and for leisure. Income. Income can be calculated as follows. Spending plus savings is equal to income. When a person's earnings or savings are not enough for their expenses, they can borrow money to spend in the present, or they can postpone their expenses for the future. Now, you can take some time to make a review and sum up. Define disposable income. What do you understand by the term spending? Assume Kenny earns 20,000 rupees a month. The table shows spending and savings for the month of April to June. Complete the table below. Let us look at the factors affecting spending. They are prices of goods and services, rate of interest, wealth, and expectations. Prices of goods and services. When price of goods and services rises, spending also increases and vice versa. Price increase, spending increase. Rate of interest. When banks offer a higher interest rate, people will save more, which will reduce their spending. Interest rate increases, spending decreases. 12. When people are wealthier, they will spend more than the poor. Wealthier people will tend to spend more. Expectations. People will tend to spend more if they expect prices to rise in the future and vice versa. If prices are expected to increase, spending also will increase. What is tax? Income tax is a compulsory payment charged by the government on income. In Mauritius, the Mauritius Revenue Authority, the MRA, is responsible to collect tax. The MRA charges 50% tax on incomes of households. It usually charges tax on those who earn above 325,000 rupees per annum. Income and tax payment. Here is how income tax is calculated per annum. For example, Mr. Ken earns 250,000 rupees per year. Tax exemption is 325,000 rupees. Therefore, taxable income is nil because tax exemption is greater than income per year. Mrs. Sarah earns 420,000 rupees per year. Tax exemption is 325,000 rupees. Taxable income is 95,000 rupees. Hence, income tax per annum is 14,250 rupees. Note: taxable income is calculated by income per year minus tax exempt is equal to taxable income. Income tax per annum is calculated by 50% times taxable income is equal to income tax per annum. As you can see, in the above example, Mr. Ken and Mrs. Gina did not pay any tax for the year, but Mrs. Sarah and Mr. Ben paid taxes on their taxable income. Now, you can take some time to review and sum up. You can use the following information to calculate the taxable income and the income tax per year for each person. Here are some links that you can use as additional materials. Well, we have reached the end of this video. Until the next, goodbye.